The stock market is a lot like the weather, unpredictable. Sometimes it's sunny and calm with stocks steadily rising. Other times it's stormy and volatile, with prices fluctuating wildly. Just like we use a thermometer to measure temperature, investors use the CBOE Volatility Index, or VIX, to gauge the temperature of the stock market. The VIX is often called the fear index or fear gauge because it tends to rise when the market is experiencing turbulence and uncertainty. Think of it as a barometer for investor sentiment. When investors are confident and optimistic, the VIX is low. However, when fear and uncertainty grip the market, the VIX shoots up. Understanding the VIX can provide valuable insights into market sentiment and potential future market movements. It's important to remember that the VIX itself doesn't tell you which way the market will move, but it gives you an idea of how bumpy the ride might be. Now you might be wondering, how exactly is this fear index calculated? The VIX is calculated using a rather complex formula that takes into account the prices of options on the S&P 500 index. Options are contracts that give investors the right but not the obligation to buy or sell an asset at a specific price within a certain time frame. Without getting bogged down in the technical details, the VIX essentially measures the expected volatility of the S&P 500 index over the next 30 days. It looks at the prices of both put options, bets that the market will go down, and call options, bets that the market will go up, to determine the implied volatility, a measure of how much the market expects prices to fluctuate. The higher the demand for these options, the higher the implied volatility, and consequently, the higher the VIX. Conversely, when the demand for options is low, it suggests that investors are anticipating calmer market conditions leading to a lower VIX. Now before we go any further, please take a moment to like and subscribe. We really do appreciate your support. Thank you. So we know that the VIX measures market volatility, but what do the actual numbers mean? Generally, a VIX reading below 20 is considered low, suggesting a relatively calm and stable market. This is a period where investors are feeling confident and price swings are expected to be moderate. A VIX reading between 20 and 30 is considered moderate, indicating a normal level of market volatility. This range suggests a healthy mix of fear and greed in the market. Readings above 30 are considered high, signaling heightened fear and uncertainty in the market. This is often associated with sharp price swings and increased risk. It's important to note that the VIX is a forward-looking indicator, meaning it reflects market expectations for future volatility. While a high VIX suggests that investors are anticipating a bumpy ride ahead, it doesn't necessarily mean that a market crash is imminent. The VIX can be a valuable tool for investors looking to navigate market uncertainty. While you can't directly invest in the VIX itself, you can trade VIX futures, options, and exchange-traded products that track its movements. For example, some investors use VIX-related instruments to hedge their portfolios against market downturns. When the VIX rises, the value of these instruments typically increases, potentially offsetting losses in their other holdings. Others use the VIX as a contrarian indicator. They might see a spike in the VIX as a buying opportunity, reasoning that fear has pushed prices down too far and that a rebound is likely. However, it's crucial to remember that trading VIX-related products can be complex and risky, especially for novice investors. The VIX is a powerful tool that can provide valuable insights into market sentiment and potential future movements. Understanding how to interpret and utilize the VIX can be beneficial for investors of all levels of experience, helping them make more informed decisions in a constantly evolving market landscape. Have you liked and subscribed yet?